A lot of people are often interested in whole life insurance for specific reasons. They want to use the policy as a financing tool to acquire more real estate, invest in their business, maybe it's to pay off debt. Often they come to us with a number of goals when we work with individuals, but the number one glaring question we always get is, I know how I want to use the policy, Steve, but how do I maximize the cash value? And what are my options when it comes to different products, different companies? How do I make sure, as the consumer, that I am getting the absolute best value? Like, this is my money going into a policy. I want to make sure that I don't have any type of buyer's remorse after the fact. So in this video, we are going to go through exactly our process with respect to showing people how to maximize the cash value, showing a number of options with different companies and products. Let's have some fun. So what we have here with respect to a case study is something that we see quite frequently. We've got a 40-year-old individual paying in $100,000 per year for 5 years. I'm going to rephrase. He wants the ability to pay in $100,000 per year for 5 years. After 5 years, he might want to continue to make payments, but if he can stop, that would be ideal. Now, what I'll add very quickly is that number may or may not fit for you. You might say, hey, I'd like to see this same scenario, but based on my age of 30 or 50 years old and not $100,000, but $10,000, or maybe it's $1 million. What I'll say is this example, we do have a round number. If the ratios are the same, let's use technical terms. If we set the policy up exactly what you'll see, exactly how you'll see in this video for maximum cash value and flexibility from start to finish, you'll see very similar values, just remove a zero or add a zero, you know what I mean. But back to this example, 100K for 5 years. And looking at different companies and products, we're going to look at 2 of the 4 major mutual companies, MassMutual and Guardian. The products we will look at is the Hirely Cash Value product, that's a MassMutual policy. The L95 policy, you'll see in red below L95, Dividend and Index. So Guardian does have an indexed rider available that you can attach to a whole life insurance policy. It is one product, not a number of products. So it's not 2 different options, it's one policy. And what the policyholder can actually do is switch back and forth between using the dividend and indexed feature on his life insurance policy. So if he says, hey, I don't think I'll ever use this indexed rider, or I just don't like the idea of tying any of my money to the S&P 500, what we would do is either A, not attach the rider at all, or B, attach it, but put it at 0%, because then that functions as if you don't have it attached at all in the first place. It does have a nice advantage, or there is a nice advantage to having it in the event that there's a market correction and one feels that there's going to be a rebound, or I think I can do better with the S&P 500 than what I can with the basic dividend rate. It's a nice feature. There is a charge for it as well. If you'd like more information on it, I would search the term index just in the search bar of our YouTube channel, and you'll see a couple of videos pop up on it. So we're going to look at Guardian's L95 product, illustrating the dividend and index option, and then the 15 pay with MassMutual, which is a nice option to maximize cash value, particularly on the long-term internal rate of return, and build in a lot of flexibility. When I say flexibility, having the means to adjust payments up and down every year on your anniversary date, quick refresher on MassMutual, we can easily adjust payments on our anniversary date without any medical underwriting if the policy is set up properly. So if you have a MassMutual policy and the proper riders are attached, each year when your premium is due, you can adjust your total payment. I can pay $100K in year 1, $30K year 2, $70K year 3, $100K year 4. There's no issues at all as long as the payment is made on the anniversary date and it's set up properly, specifically with the Lister rider. Our All About MassMutual video touches on that. And then we've got Guardian, which a lot of people like if they want a lot of flexibility. So in this particular case, with the policy design, what you're going to see is a 10/90 split. So we are minimizing the underlying base premium in both of these examples, or all 4 of these examples really. But what that means is of the $100,000, we're going to have $10,000 allocated toward the base premium. And depending on the product and company, you're going to see 0 to a certain percentage of your premium show up in cash value. With the Guardian L95 policy, as an example, in the first year, very little, almost nothing shows up in cash value. The reason why is because the insurance company is going to overcharge you for the death benefit or cost of insurance up front. Now, beginning the second year, those base premium dollars come back to work for you. Now, before I started explaining that, I mentioned Guardian with respect to their policy flexibility. So what Guardian allows as a company is one can literally commit to that minimum base premium only, and then 100% at your discretion, you can just throw excess funds into PUAs. Now I've got the ability to commit to a minimum amount, 10% of my total desired payment, and pour in excess funds, in this case, another $90,000 per year, into PUAs. You're going to see the numbers are not an exact 1090. The reason why is we do have a term rider attached. The true minimum commitment falls between $11,000 and $12,000, but you'll get the point when you see the numbers. So as we look at these different examples, base premium dollars on an L95, nothing shows up in cash value right off the bat. Beginning year 2, I start to see the base premium come back, whereas PUA dollars are shoveled right into cash value, minus the PUA rider fee. But that's money you can access, begins to earn the guaranteed rate, dividends, compounds. The PUA rider is the key to accelerating the cash value growth on a whole life insurance policy. The more money you get into the paid up additions rider, what you will see, especially when you look at the guaranteed values, is stronger internal rates of return, more money. And that's exactly what corporations do when they position whole life insurance products with the goal of maximizing cash value as an asset on their balance sheet. It's interesting. So let's look at some numbers here. We've got this 40-year-old individual. What we're going to look at first is a side-by-side comparison. What we've got here, fun stuff, right? On the left, let's circle this in blue, you've got Mass Mutual. You've got their whole life high early cash value product and then their whole life 15-pay product. The difference between those two products is the high early cash value policy is an option that provides a nice amount of equity right off the bat. Of the base premium piece, so we've got $10,000 directed toward the premium, everything else in the PUAs, of the base premium piece alone, the $10,000 in this example, 80% of that shows up in cash value. And then we're plowing another 90 grand per year into PUAs, minus the term rider. But we've got about $92,000 right off the bat. This example will have the richest cash value in the first year among all 4 examples. This is a very nice option to present to individuals, especially if they like seeing that upfront cash value. Now, I will add that not many people select this because when they look at it and look at it over the long haul, it tends to be among the weakest of the different products that are available, but it is a good option to see because every consumer is different. Some people really like that upfront cash value because of the opportunity cost. They want to see that value there. But there's $100K per year going in there, high early cash value product. That 6% represents the company's present dividend rate, Mass Mutual's 2022 dividend rate. Then here, 15-pay, same dividend rate. This product, we can pay into it for a maximum of 15 years. I am a big fan of this product with respect to the long-term internal rate of return. Very similar to the high early cash value up front. There is a difference, especially in the first year. Here you've got about an 8% hit, where here you have almost a 14% hit. So the first year is the worst year. I know we talk about that quite a bit. But then as we look at this, what do we notice by year 5? Based on present dividend rates, you see greater values in that 15-pay. It has a lower PUA rider fee, which allows it to move forward or move faster with less drag, you can call it. But high early cash value, 15-pay. Then you see Guardian here on the right. L95, basic dividend, and then we have the indexed assumption. The indexed assumption, again, just really projects greater earning potential. The thing is, you don't know what it's actually going to do. It is an index strategy, so you have the same concept that you see with an IUL with respect to that if the market goes up, you go up with it. Market goes down, because it's still a whole life insurance product, the difference from what you'll see in an IUL is you still have a guaranteed rate that exceeds the insurance expenses. So what happens, market goes up, you go up with it, market goes down, you don't have any loss. You still receive the guaranteed rate. But again, I would search index feature on our channel if you want more info on that, because I go through the pros and the cons. There are some drawbacks to exercising that rider. So as we look at this guy, before I start going through the comparison sheet here, what I want to know, if I'm you, is are these policies set up correctly? And how do you know that as the policyholder? If you're this 40-year-old individual, the answer is it's all in the design, in the details of each policy, each illustration. And when you look at an illustration, it's typically at minimum about 18 to 20 pages long. They're quite lengthy. So what we're going to look at here are illustrations, and we're just going to zip right to the number pages here. Here is our high early cash value product. So as we look at the high early cash value policy, here's your input, annual outlay, $100,000 per year for 5 years. Now, before we just jump to the cash value, which is the attractive part where everyone's eyes go first, at least everyone that we work with, before we look at that, if I'm you and I have the knowledge that I have just being an insurance nerd, you can call me that, the boring whiteboard guy, what my question would be, if I knew exactly what to look for as a consumer with this product, would be, where is my money going? Because I know what corporations do is minimize that base premium. I know when we throw illustrations out and look at actual historical data, policies that have lived the test of time, the lower the base premium, the greater the internal rate of return is for the consumer. There's no questioning that. That's always been the case. So, at least with the big companies and policies we've seen and we've written, although those are more recent, there's your underlying base premium, $10,000. Where we came up with that number. Here we've got Mass Mutual. They will allow us to have a minimum premium of 10% of whatever our total desired payment is. So this 40-year-old individual says, I want to be able to pay in a maximum of $100,000 per year. So what we did is, based on the limits that we can work with, is set that minimum premium at $10,000. Absolute minimum, minimizing the insurance expenses and juicing the cash value. So here's the $100K per year going in. Nothing paid in thereafter, after the first 5 years. Net cash value, right off the bat, $92,000. Positive between years 4 and 5. This matches the Excel spreadsheet, as we always take the numbers from the full illustrations and export them on Excel. So we have an easy side-by-side comparison. Now, before we look at the next example, the 15-pay product, here's what I want to highlight. The death benefit. The individual, that 40-year-old male, said, I am interested in the cash value. That's what I want. How do I maximize that? The death benefit, I don't care about that right now. I've got term or more than $1 million is plenty in my mind. He's focused on the cash value. We want to provide education on the cash value. The death benefit does have a long-term benefit as well, but right now he's interested in the cash value. Okay, so the death benefit has a direct relationship to MEC limit. That's the thing we always want to remember. An individual's age and death benefit, along with the guaranteed rate now, has a direct relationship on the MEC limit of a policy. Now, in this example, we overinflated it. It's at $113,000. The reason why is this 40-year-old individual, age 40, might want the ability to continue to pay that $100,000 per year payment beyond 5 years. He might say, hey, I want to keep going for a total of 30 years. So when we design policies, if someone has an intention to fund for a longer period of time, we'll always stress test it. And in this particular example, we overinflated it a bit to make sure that we would not run into a MEC in any situation, present dividends, conservative dividends, or even the guaranteed rate for that matter, which you typically don't have to worry too much about that. But my point is we want to make sure we never run into a modified endowment contract. So here's our high early cash value product as far as where the money's going. If we look at the 15-pay product, you'll see a lot of similarities, a little different here though as far as the base premium. So with limited pay products like a 15-pay or like a 10-pay, it can be challenging to get that base premium down to a true 10%. You can do it with the 15 pay product, but you do give up a little bit of flexibility. We cover that in our limited pay series. If you want to watch that video, we specifically go through this type of product. But here, what I will add is while this is $15,500, you do see a little bit more than 25% of that, of the base premium, this $15,523, about $4,400 shows up in cash value right off the bat. So what that actually does is bring your base premium, the amount that does not show up in cash value in the first year, to about $11,000. So it functions similar to that 1090 split design. Now, as we look at this guy, $100,000, about $86,000 right off the bat. And there we go, matching the Excel spreadsheet, breaking even between years 4 and 5. Pretty neat, right? When you actually look at this. MEC limit, bottom right-hand corner, like what we'll always see. 102. In this example, we had no desire to fund it beyond 5 years or a maximum of 15 years, really, because that's how long we can pay into the product. But we don't have to worry about any MEC in that case, based on the present design of the policy. Looking at the Guardian examples, here we go. Where is the money going? Here's the example with the indexed feature not being exercised. Here's your underlying premium. What do I see? $10,000. Can actually squeeze that a little bit lower in this example, but we set it at 10K, which gives you a whole life death benefit of about just about 510 if you want to call it that. If we were to stop there, that would give you a MEC limit of about $25,000. What does the MEC limit have a direct relationship to? An individual's age and total death benefit on a policy. For a 40-year-old male, this is a product with a 3% guarantee. That death benefit of $2,050,000 gives you a clean $100,000 MEC limit. It's like 101, but it's right there. So what we did here is I did not want to increase the premium, because how I increase the MEC limit is by increasing the death benefit. One way to increase the death benefit is by increasing the base premium. Does the base premium show up in cash value in the first year? No, that's why people don't like it. It also hurts the performance long term when you look at illustrations, guaranteed values, most importantly, actual real performance, real data. So what we do in order to keep that premium at a minimum, which is exactly what corporations do with this stuff, is they attach this guy here, this target additional benefit, which is a term insurance rider, which is a cheap way. If you don't like the word cheap, I like to refer to it as a cost-effective way to raise the death benefit, which mainly raises the MEC limit. So here is the actual dollar cost for our term rider in the first year, about $514. That actually decreases each year, and we do chop that off after 7 years in this example. So here we go. There's the funding. Where's the money going? The premium we had up in red, $10,000. There's the cash value right off the bat, about 83%. Break-even point, year 5 in this example. I've paid in $500, and now I have $500. Typically with a break-even, it should, depending on your age and health, fall anywhere between years 3 and 6. Used to be years 3 to 5. That was before the 7702 update and where there's a lot of changes to whole life insurance. With things designed properly, it should typically break even between years 3 and 6. Where it would fall year 3 is if it is a high early cash value type product. Typically it's between years 4 and 6. Here's a year 5 example, right? 3 to 6, just a good indicator as far as what do I look for if I'm trying to figure this stuff out on my own. And if you're still watching this video about 20 minutes in, chances are you are trying to figure this stuff out on your own, or you want to know it to make sure it's truly set up properly for you. Of course, you can just let us know, Steve, IBC Global, is it set up right? And our answer would be yes. Here's a refresher if you like it, or if you just say, give me the quick notes. Here you go. Yes, it's set up for maximum cash value. So after the funding, nothing goes in. Cash value continues to grow. Then we've got the same example here with the indexed rider. So the only difference here, this is the exact same policy. You can see it with the exact same death benefit. We've got the indexed rider at 100%. You don't have to go 100%. You go 50%. And what that means, if you go 50% index, is that you're electing to tie 50% of your cash value to the indexed feature, the S&P 500, and the other 50% to the basic dividend. So you can actually go back and forth. You can only adjust it one time per year. It's about 2 months before your anniversary date, but that is a nice feature to be aware of. So going back to the Excel spreadsheet here, to compare everything in a simple format or a simple fashion, okay. Got it all side by side. What I want to touch on, we're going to look at the guarantees after we look at this too, is this guy. You've got dividend interest rates of 6%, and then Guardian, 5.65%. And for their indexed feature, it's an assumption of about 6.2%. Then I did not include the average IRRs, just the annual IRR, which simply shows what is the net growth rate, internal rate of return that I am growing, that my policy is growing by year over year. Specifically, cash value. That's what I'm isolating. What's the growth rate? Not the dividend, the net growth rate. That's exactly what this shows. And again, year over year. Your average IRR would be in the red, negative, until you break even. When you have more money in cash value than what you've paid in, then if we had the average IRR column, at that point in time, we would see that in the black, which is good. That's what we want. I hammer that home so much. If you've seen any of our videos or more recent ones, I keep on touching on that because a big point of pain that consumers have is often they're attracted to these dividend rates, these guarantees, and they are under the impression that that's what they're actually going to earn on their money. Hey, the dividend was 6% last year. I had $100,000 in cash value. Why did I not see $6,000 in earnings there? Like, what's going on here? Now, the reason why is whenever I see a dividend rate, that is a gross rate that is credited after the company's insurance expenses. So what's the net IRR, meaning how much did my money grow by each year? So we do like to disclose that in an effort to provide full transparency, which is really the mission of our company. So we've got that. Same thing with the 15 pay. And when you look at these guys over time, if we just isolate 25 years in, what do you notice here? There's not a huge difference between them. There's your high early cash value, the weakest long-term, 1.12 million. You know what, it's gonna be, there we go. 1.12 million. 15 pay, almost 3 million, 1.28 million. So that's a big difference there when you look at it. It's about $160,000 more, same company, same product, same design, the minimum base premium, higher crediting rate long-term. Has to do mainly with how that product functions long-term. The company's not overcharging us for the base premium with the 15 pay product. Has lower PUA fees. It's also got a lower guaranteed rate, which if you haven't done much digging into whole life insurance, what you'll find is the lower the guaranteed rate, the greater the non-guaranteed potential. If you want a deep dive on that, we've got some videos, search how dividends work, and you'll see a deep dive on that on our YouTube channel. And then you've got Guardian, based on their dividend, 1.25 million, 1.25, so not a big difference there when you look at them. A little bit stronger IRR with the mass product as they have a slightly higher dividend rate. Guardian is close. What you gain with them to say, okay, I've got a little bit less value there, but you have added flexibility. We can add PUAs at discretion. And then the indexed feature looks phenomenal, but again, that's all hypothetical based on S&P 500 and that history, which I don't like to bank on that. Frankly, I don't like to bank on any of these illustrations. What I like to look at with whole life insurance is actual data. What has actually happened over the years in terms of real performance. So valuable. And when people have that awareness or they're working with someone that has that awareness, that prevents so much heartache, so much buyer's remorse, because where people feel duped with whole life insurance is when they see these fantastic projections, they buy the policy and then find out after the fact, wait a minute, it's under delivering. Why is that? Well, the dividends went down, the other pieces I can't explain to you with respect to the base premium, the PUA fees. There's reasons behind it. We can always explain as to why, but my point is when policies are set up properly, with the major mutuals, properly designed, that's where we see them deliver strong results, and that's what corporations do. And we can just copy that model with respect to whole life insurance if it's a fit for you as you look at everything. So let's look at the guaranteed values. So we've got the same options here. You'll see one Guardian column, and the reason why is we're only running the guarantees, which assumes no dividends, no indexed feature, nothing like that. Mass Mutual, high early cash value product, has a guaranteed rate of 3%, and their 15-pay product has a guaranteed rate of 2.5%. So as we look at this guy, 100 for 5 years, breaking even between years 9 and 10. Annual IRR, you have a guaranteed rate of 3%, which might not sound attractive to anyone because it's not that attractive really. When you compare it to bank accounts, it's like, wow, I don't even get 0.03% in my bank account. Depending on where you bank, you might get 0.3. But it is attractive in that respect. Also, if you do everything right, that is a tax-free benefit. Core benefits to cash value life insurance, safe, liquid, tax-free. So it is attractive in an absolute worst case scenario, attractive to some. But still, does it ever hit 3% when we look at it? No. Why? Because a guaranteed rate or dividend rate is not a net rate with respect to what you're actually earning on the policy. Oopsie daisy. It is a gross rate, and the IRR is your net rate, which we, again, like to make very, very transparent. So, 15-pay, breaking even. Year 10, same thing. There's your IRR over time. Then you've got the Guardian example. Guardian has always paid attractive or carried attractive guaranteed cash values. I've always noticed that to be the case, which I'm a fan of, frankly. Will I actually see it perform or produce the worst case scenario? Likelihood is no. Almost with any company, really. Right? All companies have paid dividends for over 100 years. Most companies, the major mutuals, over 150 years, 160 years actually. It's a long time. Like Guardian of the major mutuals is the smallest. They've been in business for 161 years. Right? And they're a huge company, but compared to a Mass Mutual, New York Life, or Northwestern, they also are smaller, but they're one of the 4 major mutuals, which mainly what that means to me is I've seen them consistently deliver strong cash values to policyholders. And when we work with corporations like the bank we work with, guess who they use? The specific bank we work with from personal experience, Mass, Guardian, and New York Life. First purchase they made was Mass and Guardian, then Mass, Guardian, and New York Life. So I hope you enjoyed this one. I know we covered a lot of details. I wanted to hit on a lot of talking points that many people have when they work with us, just covering the comparison, putting everything side by side. We do give recommendations, but it's really up to you when you're choosing a policy. What option do you want to go with? We help guide you in the right direction, and it's ultimately up to you. And we set up any policy that you'd like. And if you do decide to work with us, you're with us for life, or we stick with you for life, I should say. Everyone we work with, we reach out to them every 6 months to provide ongoing service. We've got exclusive content, and then we also provide mastermind calls, you can call it, or just really private calls where we invite all of our clients, some of our partners as well, to attend and really just discuss cash value life insurance strategies, whether I'm investing in real estate, using it to pay off debt, velocity banking. My good friend Denzel is on those calls. At times we've got those once a month, but a lot of additional info. I hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thank you so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.